I have personally made hundreds of thousands of dollars trading the financial markets. I tell you that to add credibility to the 8 brutal truths about trading that I'm about to share with you in this video. I will not be sugarcoating it, and I'll be sharing my genuine experience as I've almost been trading for 10 years and I have reached a point of consistent profitability and handily outperformed the S&P 500 in the last 5.5 years. I don't tell you that to brag, I tell you that to add credibility to what I'm about to share. Trading, as you probably have found out by now, is incredibly difficult. And the first hard truth that I'm going to be telling you is that absolutely day trading and scalping is trading on hard mode. In my career, I've had the pleasure of working with and interviewing all sorts of money managers, professional traders, and some of the top tier traders of the industry. And I can only count a few of them that day trade or scalp, but I can count countless traders that I know that are consistently profitable and have proven it. They have verifiable records. They manage money for professional clients that swing trade or position trade. So by trading the lower time frames, what makes that so difficult compared to swing trading and position trading? Well, the big answer is trading costs are way higher on the lower time frames because you're in and out all the time and you're trying to capture a lot of gains on a noisier side of the market. Like I said, I know countless swing traders, position traders, and investors that are consistently making money in the markets. I know very few that are day traders that actually do so profitably. One of the hardest parts about day trading and scalping is you're going up right against some of the algorithmic trading that is dominating short-term timeframes in the financial markets. Whereas I believe the retail trader or the common person who's accessing the market can still find opportunities on a swing trading basis and holding things for a little bit longer. Day trading and scalping, it is the admiration of the retail trader because it's exciting. Get in, get out, make a big profit, and go home. But I don't know very many profitable day traders, and I personally think it is the absolute hardest way to trade, and it is probably why a lot of people are failing in trading. The second brutal truth I have for you is you should probably be staying away from prop firms unless you are an extraordinary trader already. Prop firms are not inherently bad. They're a great way to scale up, but the prop firm industry is built on losing traders trying to get funded all of the time and throwing much more money than they should into prop firm challenges on repeat. A lot of traders think, oh, if I just get a prop firm challenge, then I'll be saving money because I'll not blow up my personal account. Well, it doesn't make any difference if you spend thousands of dollars on prop firm challenges and just blow those instead of just blowing $1,000 of your personal live capital. Again, I want to reiterate, prop firms are not necessarily bad. They are a great tool for traders who do have risk management, do have strategic edge in the financial markets, and actually have some experience behind them. But I see traders in their first year donating money to prop firm challenges on repeat, and they have no business doing that. That is one of the easiest things to stop doing if you are losing money in the financial markets and don't know what you're doing. You need to pause all sorts of activity on let alone a live account. You should definitely stop things on a prop firm challenge, kind of rotation. If you're just donating money to prop firms, put that on pause and actually go back to a demo account and treat the markets with a little bit more respect. The third critical point that I have for you is stop chasing big monthly returns. If you're looking for 10, 15, 20% return on investment each month, you're likely to blow up your account and start back to zero. And anytime you start making gains, you're going to multiply that right back down to zero because most people have a position sizing problem in what they're doing in financial markets more so than anything else. They lack edge, yes, but the quickest way to burn a lot of money in the financial markets is with improper risk management. Risking anywhere from 0.25% to a maximum of 2% on a particular trade is probably better off for most people in my personal experience, opinion, and testing. I think that traders should shoot between 2 to 5% average monthly returns, and this is very good trading behavior. And statistically, being able to consistently make on the upper echelon of that, the 5% range on a monthly average long term, would put you in the top 1% of greatest traders of all time. If you don't believe me, check out this video that I did where I actually went through some of the top trading returns of history from professional traders and money managers with verifiable track records. What you'll usually get in response to this is, oh, but my friend can make 10% per month, or so-and-so influencer says they can do this. But all of that is hearsay hearsay and it's total nonsense until you actually see broker logins or MyFXBook or third-party track recorded sites that actually show you their results, and nobody is putting up 10, 15, 20% monthly average returns over a long period of time. You might have a month or two that you're doing that, or 3 months or 4 months, but it is incredibly unlikely that a trader can make that kind of money consistently over the long term. And guess what? You can get incredibly wealthy with 2 to 5% monthly returns, and you can get funded, and guess what else? You could even get investors to back your trading if you're good enough and can actually do 2 to 5%. For most investors, that is a phenomenal return. And if you could generate that on a consistent basis, you could get funded millions upon millions of dollars. You don't need big percentage returns, you need consistency. And if you're a trader outside of the US, listen up for a second. Vantage Markets is today's video sponsor, and they are a brokerage that offers CFDs on pretty much everything you could possibly want to trade. If you want to trade Forex, if you want to trade crypto, if you want to trade indices, gold and silver, they have a CFD platform that has very low trading fees, and they're offering a very generous welcome bonus to new clients at this time. For my subscribers, if you use the link in the description down below, you can get access to Vantage and take advantage of their welcome bonus that they're currently doing. They also offer a copy trading platform, which is pretty advanced, and a ton of educational resources to their traders. You can also trade directly on tradingview.com with Vantage, and they offer MetaTrader as well. So if you're looking for a better brokerage, consider checking out Vantage down below in the description or pinned comment below. The fourth point kind of goes with the previous one, which is trade size is the thing that you can control the most in trading. You can't control what the market does. You can't control what some politician says on social media. You can't control those things. All you can control is what you're trading and how big of a size you have on it. And that is critical because most traders have a problem with position sizing more so than anything else. They're risking way too big on a trade, and even if they have a hot streak, they give it all back and more on one losing streak. By risking small enough, you can survive drawdowns. By risking too big, you blow up. And of this list, that problem right there is probably the thing destroying most people. And in all the conversations that I've had with traders that are really struggling, almost always, 99.9% of the time, problems lie in the risk management. So there's a good chance that if you're struggling with your trading, risk management is a problem for you too, and you need to go back to the drawing board. Again, I'm not here to sugarcoat. I'm telling you what costs traders the biggest. Number 5 is a huge one. You never know with certainty what the market is going to do. Stop thinking for even a split second that you have a certainty as to what direction the market's going to do. The good news is you don't need to know what the market's going to do, and you don't need to predict its every move. You just need to risk small and win slightly more than you're losing, and over time, watch that compound and grow. Number 6 is painstakingly obvious, but nobody does it. Backtest. Truly spend time backtesting and really dive deep and embrace the process of testing strategies thoroughly to determine if your system that you are trading currently actually has a consistent edge over time. What you will find when you actually spend time backtesting is it's very hard to find an edge in the financial markets. And this is one of the biggest things holding back traders from being profitable. No, it's not trading psychology or discipline. Those things can be picked up relatively easily in comparison to finding edge in the market. It is very hard to find a system that produces a really solid edge that generates more profits than losses over time. And most traders disregard this thinking it's just my emotions costing me, when in fact it is risk management in combination with an actual defined edge or a strong edge in financial markets, which is very difficult to find. I did a whole video on this topic and I really had a lot of fun doing it. So if you want to hear more about my thoughts on the importance of finding a trading edge, check out the top right hand of the screen right now and click that video link to check out more. Number 7 is stocks, gold, crypto, and other risk assets have an upward drift over time. Now, what this means is that over time, assets grow in value. Real estate, gold, silver, stocks, great companies, right? Economies tend to grow over time as the world progresses, technologies improve, there's a bigger population, economies grow, etc. Now, the reason I mention that, and the reason that that is important, is that most of the time, those assets do tend to go up. Some of them go faster than others, right? Sometimes Bitcoin makes big moves up and down. They have different levels of volatility, but they generally tend to trend up in the long term. It does not mean they can't have multiple years down, or serious corrections, or steep sell-offs. But the reason I'm saying this is that it is very difficult to try and short assets that appreciate over time, and it is much easier, in my experience, to be on the long side after carefully waiting for a good entry point. Now that is critical because a lot of traders get destroyed trying to short gold in an uptrend, short the NASDAQ, short the S&P 500. All of these things can cost you big. And by simply respecting kind of the way of the market, those things tend to drift higher over time. It is a thing that you can find and build edge around a lot easier than trying to short those things or day trade those things too short term. By day trading, this brings back to that earlier point about why day trading is so hard. One of the big reasons is that these assets do appreciate over time, but sometimes it can take time for those things to resolve to the upside. So if you have a strategy that generally goes with the market or appreciates with the market, meaning you're predominantly long stocks, crypto, gold, etc., commodities, there is that appreciation over time. But if you're day trading, you're unlikely to capitalize as much on that. A lot of it is overnight holding periods. That is where some of the edge to that rising over time in asset prices tends to be delivered. So the takeaway here is that you should probably avoid shorting those things for the most part, unless you have a very good reason and a very sound setup as to why you'd like to short gold, stocks, etc. Again, these things in relation to fiat currency should rise over time. So by shorting them, you are taking the harder end of the trade most of the time. One caveat is that if you're correct about shorting the market or shorting an asset that generally appreciates, the sell-offs can be very vicious and pay out very big, but again, very hard to time. I personally have found it to be much easier to be on the long side of appreciating assets, but to wait carefully for good setups within those trends. Last part, adding in trend is a big filter as well. Making sure that I'm trading with something that has momentum and is trending up adds a level of confluence to what I'm doing. And finally, for the currency traders out there, currencies are not like appreciating assets. They do not have upward drift or downward drift like volatility does. The currency market, if you pull up a chart of the euro dollar or the pound dollar or the dollar Swiss franc over the last 10, 15, 20 years, you will see that it does a whole lot of chopping. It just goes back and forth. So some of the longer term upward drift that can be taken advantage of in assets and stocks and indices are not necessarily something that should be applied or searched out in currency land. In fact, if you like range bound markets, currencies can be wonderful for that and something that you should really be careful about. I've got a bonus round here for you, which is for the options traders. I know I've talked a little bit of everything. Buying calls and buying puts, there is a time and a place, but you are fighting theta decay. And if you don't know what I'm talking about, if you are not an options trader, options essentially lose value over time. So they are decaying assets. We talked about appreciating assets like stocks, real estate, gold, etc. Depreciating assets like options are something that should be, in my opinion, hesitantly bought. So if you want to make a big bet that the market's going to make a big directional move, you can buy a call, which is a bullish bet, or buy a put or a bearish bet. But use these things sparingly because you are paying for that time value that is decaying. So for the options traders, be very careful on the long call, long short side of things. And instead, in my opinion and my experience, look more for credit-based trading approaches or selling options where there is some theta decay that works in your favor. These are edges that you can find in the financial markets that are not going to make you rich overnight, trust me. And there is still risk involved, even if you have edge in the market. But these simple theories can add over time to finding profitability in the financial markets. I've done my best in this video to share authentically some of the things that have genuinely helped me so much in my trading journey. I have gone from being a losing trader to genuinely making, as I pointed out in the beginning of this video, I'm very thankful, grateful, and honored to be in the role where I have followers, and I'm also grateful for my trading journey. I've made hundreds of thousands of dollars in the financial markets through blood, sweat, and tears. And I hope this video was helpful to you. And I also invite you to subscribe to this YouTube channel if you're new, and also make sure to subscribe to our free Telegram channel. I'll leave a link in the description down below. If you want to find out more about how I trade, you can also go to our website, a1trading.com. Thanks for watching. I hope that video was helpful to you, and I also wanted to make sure to share our Telegram channel with you. Every day, we are posting up chart markups and analysis and in-depth breakdowns of what's going on both fundamentally and technically in the markets. We also drop bonus videos in the Telegram channel, so don't miss out. Come join our Telegram channel. The link is in the description down below. Have a great rest of your day.